All right, you should be seeing one big slide in front of you, and that's where we're going to start.
I see it.
All right. So welcome everybody. As Ashley said, my name is Karen Chan, and it's my pleasure to work with the Vernon Area Public Library tonight to talk with you about something that we wish we didn't need to talk about, but for many of us, the pandemic has brought about challenges in various ways regarding our money management. And so tonight's very timely, I think. Ashley alluded to this, so it makes it on the recording. I'll reiterate that I've been doing personal finance education now for, I don't know, about 27 years. I am a certified financial planner. However, I do not practice. That means that I don't take clients. I only use that training to do education. And I sell no products or services, no financial products or services. And so my goal is that my presentations are as unbiased and pure information as possible. We're going to cover several main topics tonight. We're going to talk about the big question that is sort of the root of doing the best we can with our finances, and that's knowing where our money goes. We're going to talk about strategies for building savings. Ironically, during the pandemic, because of some of the assistance programs that were put in place by the CARES Act last spring, some of us have had debts that we aren't having to pay at the moment, and it may have given us an added opportunity to build savings for when perhaps those programs are over. Then we're going to talk about specifically how to handle a drop in income and managing debt, including when you're unable to pay a debt. And at the end, we'll talk briefly about some of the government assistance that's available. So like I said, this is sort of the $64,000 question, where does your money go? And even if you knew what your budget looked like before the pandemic, I'm sure you have seen changes since it has started. I'm going to suggest that if you haven't been tracking expenses up to this point, that you do kind of a quick start approach to getting a general handle on where your money is going. And I'm going to call that a quick start, which is looking back at the past month. We're now just into the beginning of February, so probably looking back at the month of January would be a natural starting point. There's a worksheet that I have up on my webpage if you want a tool to help you with this. It's, as you can see, it's quite simple. It lets you list the date of expenses, put them in various categories, and then total them up by category. To do this, I would like you to look at your checking account. Look at your credit card statements. If you have, paper bills or electronic bills that you have, receipts that you might have collected on the desk or kitchen table, look at all of those, along with what cash withdrawals you might have made from your banking accounts, and try to reconstruct as best you can where your money went last month. The hardest piece will be if you do use cash for several things. That's what is most easy to miss when you're trying to do this look back, this month-long look back. But this is the starting point. And what we're going to do with this is use that historical information to make a plan for where you expect your money to go this month. There's an excellent worksheet for this in a publication from the Department of Labor. And whenever you see something I've put up on the screen that says either KarenChanFinancialEd.com, or it says DOL, which is Department of Labor, as this one does, or the next one's going to say University of Illinois Extension, that's telling you the source of these tools. And at the end, I will tell you where to find the links to all of these things. So this particular worksheet gives you a place to, once you've recreated your expenses from the past month, to come here and for each spending category, and of course the example that's visible here is utilities, make your best estimate of what you expect those things to cost this month. If you're looking at something that doesn't happen monthly, you can enter it as an annual expense. This is your projection, not necessarily the exact amount that you saw from January, but how much you think you'll spend this month. But the baseline is what you figured out from January. Then over the course of February, track your spending so that you can come back to this form, and in the column over further to the right, you'll be able to list what did you actually spend in each of these categories. And then, making a note, was it more or less than you planned? Was there something unusual that happened? And I'll just give you a heads up. There's something unusual that happens every month. So don't be surprised when something does come up that kind of throws your plan a bit off. Now, I don't really care what tool you use to do this. Like I said, this is a nice one that's from the Department of Labor. It's available in a print book and as an interactive version. My old friends at University of Illinois Extension, where I worked for about 20 years, have a nice, simple, straightforward worksheet that you can print off from their webpage for their money mentors. And one other thing that University of Illinois has that I suggest you use as you're working on your spending plan, not just for the month of February, but thinking about the year as a whole. And that is to think about those expenses that don't happen every month, occasional and seasonal expenses. Now, in normal times, this would include things like holiday celebration expenses, vacations, back to school clothing for the kids. There are still going to be some occasional and seasonal expenses right now, but they may not be quite the norm that they used to be. But nonetheless, this simple worksheet, again, simply with the 12 months laid out with a list on the side to give you some ideas of what things that you may want to put here. This will help you make sure that as you are making your spending plan and using it from month to month, that you've incorporated the things that might otherwise catch you off guard. For me, property taxes are one of those, twice a year. Others are like membership fees, the tags for your car and things like that. Now, the purpose of creating this spending plan, first of all, don't ever expect your spending to exactly match your plan. It just doesn't happen. That doesn't mean the plan isn't working, because in my opinion, the purpose of the plan is to guide your decisions. And I'm going to tell you a little story that I think illustrates that really well. A number of years ago, I was doing a train the trainer class for staff working with social service agencies who were working, who themselves were often relatively low paid because they were in the nonprofit sector, but they were working with specifically limited resource audiences as well. I was teaching them a budgeting technique called envelope budgeting, which we'll talk about in a moment. I'd given them each 3 envelopes. I'd said, before you go to bed tonight, if you do use cash for these 3 categories of expenses, put the cash in the envelopes, and I want you to use them for the next week. This is your budget. Like, you might put groceries as the spending category for one of the envelopes, maybe snacks. You go to the coffee machine at work, or you go to the snack machine. Whatever it is that you spend on a fairly regular basis, maybe it's something that, they're small expenses, but they add up, and they're things that you use either cash or a debit card for. And I said, next week, I'm going to ask you to come back, tell me how it went. So hopefully everybody went home. They either put the money in the envelopes for the 3 categories of expenses they'd identified, and they had to say how much they expected to spend over the course of the week. And then that's how much they put in the envelopes. They come back a week later, and I said, well, how'd it go? How did the envelope budgeting work? And this one lady speaks up and says, it didn't work. Well, that wasn't quite what I was expecting. And I said, so tell me, what happened? She said, well, my first envelope was lunch at work, and I put my $15 in there that I spend every Friday. That's the only day I let myself go out to eat. And my other envelope, the second envelope, was groceries, and I put my $100 in there. I go grocery shopping after work on Monday every week. And I don't remember what the third envelope was that she said, but it doesn't matter. I said, okay, so tell me about this. She says, well, I went out to eat on Friday and I spent my $15, and then I go to work on Monday, and they said, oh, it's Hayhor's birthday today, and we have to take him out to lunch. And I'm thinking, I don't have money for this. All I've got is my grocery money, because I wasn't going to do anything today like that. Well, I said, what'd you do? She says, well, I went to lunch, And I had to pay my part and my part of his lunch, and so it was like $20. And I said, so how did you pay for it? Well, I took $20 out of my grocery envelope. Okay, what did you do when you got to the grocery store after work? Well, it wasn't easy, but I managed to get out of that store spending $20 less than I usually do, because I only had $80 in my envelope. I didn't have 100 like I usually did. And I looked at her and I said, I think that means it works. Because, well, I'd asked her one other thing. I said, what if you hadn't divided your money up in the envelopes? What would you have done? Well, she said, well, I would have, paid my part of his lunch. And at the grocery store, I would have just spent my usual $100. But because she had a plan, because she knew she'd spent $20 more than she expected, she knew what she took it from, she was able to adjust her spending to keep within her overall plan, within her overall budget. That's what I mean by a spending plan guiding your decisions, because you know what the plan is. You can adjust it when needed and circumstances change. And I thought her experience was a great example of that. Now, what happens if, as many people do, you do this spending plan, and part of that is recording your income and comparing your income with what you're spending. It's not unusual for people to discover that they are spending more than their income. If that's the case for you, maybe it's been the case for quite a while, or maybe it's become the case as your finances have changed since the pandemic. First, I'd like you to look at your flexible expenses, the ones that you have a lot of control over. And my example uses one of those. Groceries are a very flexible expense. I mean, let's face it, for protein, you can eat beans or you can have T-bone steak. There's a lot of difference in price there. And you have real-time impact because you're spending that money and saving and changing that expense amount on a day-to-day, week-to-week basis. You don't have to wait months before you see the impact. If flexible expenses like groceries, like clothing, like entertainment, things that you don't have to pay every month, if you need to cut more, then look at your fixed expenses. Fixed expenses are ones that the amounts are pretty much set from month to month. Think insurance premiums, think cell phone bill, think internet, think car payments, mortgages, rent. Those are all fixed expenses. And to change them often takes breaking a contract, renegotiating, changing providers, moving. And so that's why you target flexible expenses first. They're like the low-hanging fruit. If you can't control your expenses enough with the flexible expenses, then you look at the fixed expenses. Now, maybe you're in the pleasant position right now that your income is bigger than your expenses. And maybe it wasn't always this way. Maybe it's because your expenses have dropped while we're all pretty much staying home and not eating out. And, my husband normally works downtown, which means we were spending over $200 a month on public transportation. Those expenses went away when he started working from home. So if your plan shows you that your income is greater than expenses, that should mean that you're saving money every month. If you're not saving money, if you aren't seeing the balance in your checking account increase, or seeing the amount on your reloadable prepaid debit card or whatever, if you're not seeing your balances increase, you may have missed some expenses, so go and look for those. But if your income really is greater than expenses, don't let that savings slip through your fingers. For many people, my sister included, if she has more income one month than she spends, she leaves it in her checking account, and I guarantee you within the next month, that extra money will have been, and I don't want to say frittered away. It's not that she would use it for unimportant things, but she would spend more. She might buy something now that she was going to be holding off to buy later. And in the end, she would end up without savings. So at the end of the month, If you see that that you have some savings that you didn't spend, move it to a different account, like a savings account, or use it to pay down debt, so that you're making use of that money before you kind of lose track of it and it just gets used without your realizing it. So, as I said, you've done that historical, looking back to last month, you've done your spending plan. And remember, the next step is to track your expenses for the month of February, or if you don't get started right away, maybe it's from February 15th to March 15th, whatever works for you. Just as you did when you made your spending plan, total your expenses up by category, compare it to your plan, and decide how you need to adjust your spending plan for next month. You don't have to keep using a spending plan that didn't work. Adjust it. It's not set in stone. Make it a living, breathing tool that adapts as you need it to. Now, to track expenses, some of us have tried and true ways that we've done it, and some of us may not have successfully tracked expenses before. There are lots of ways to do it. It doesn't matter how you do it, as long as you choose the way that works for you. Some people are total computer geeks, and, or I guess we don't have to be a computer geek anymore to do a lot of stuff on the computer. But you know, if you use your phone for everything, or you spend a lot of time at your computer, you may want to use a downloadable app that helps you track your expenses. Maybe you're an Excel spreadsheet guru and you want to enter everything. If you're looking for phone apps, I did find a couple of good reviews that talked about several different apps that might be good in various situations. And so I've given you the links to these here. And all the links I'm mentioning, you'll find on the webpage that I'll give you the link to at the end. So like I said, whether you're using something like Quicken or you're using a spreadsheet, maybe you're an old pen and paper person, there's nothing like being hands-on with this. There's an expense tracker tool that I've got on my webpage that you can use. University of Illinois Extension has a great one. It's kind of cute because it has icons for all the spending categories across the top. Whatever method you choose is fine, even if it's that envelope budgeting thing that I talked about earlier. Envelope budgeting is supposed to require the use of cash. You can kind of adapt it, but the concept behind envelope budgeting is very sound, and it's worked wonders for a lot of people. As I described with my little story earlier, you choose your categories that you're going to track. Maybe you're not going to do everything all at once. You might choose only categories that you think you're having trouble with, or only the ones that you're using either cash or a debit card for. You label the envelope with the category. You write on the envelope the amount that you expect to spend either over the week or the 2 weeks or the month, depending on what time frame you're setting your spending plan up for. And then when you buy something in that category, you use the money out of the envelope. It forces you to recognize when you're running low. It forces you to recognize if you've overspent and you're using money that was supposed to be for something else. There's no math. It's very intuitive. It's very concrete. It's a really good way to limit overspending, but there are security issues if you're not in a situation where you are really confident that your cash will not be tampered with by anybody else. There's always a risk if you are carrying your envelopes with you. You know, there's always a risk of theft or loss there, so you do have to recognize that. So if you'd rather do the debit card version, you can still use the envelopes, but you start using them as a place to collect your receipts, and you write on the envelope itself each receipt as you put it in and subtract it from the amount that you had budgeted. WikiHow has a nice explanation about envelope budgeting. To be honest, I don't often like the explanations I find on WikiHow, but this one was spot on. All right, so enough about figuring out where our money goes. Let's talk about strategies for building savings. And a little ways into this, I'm going to show you an example of why it is valuable to save money, even if you can only save a little bit. Just getting started is the biggest issue, the most important thing. You know, for about the last year now, I think we all recognize that we've been living in a time of uncertainty. Uncertainty about if you work in the entertainment industry, or if you work in the airline industry, or if you work in restaurants. Uncertainty about whether you're going to work tomorrow, whether your child's going to school tomorrow. All sorts of things that we just don't know what to expect. In times of uncertainty, cash really is king. If we're not sure what our job looks like, what our income looks like for the next week or month or several months, if it's uncertain whether I'm going to have to be paying someone to look after my child or not, things are just up in the air. That means that an emergency fund is a very valuable thing. An emergency fund is money that's easy to access. Maybe it's in a savings account. Maybe it's the old cookie jar thing. You want it where you can get to it relatively easy, but not too easy. This kind of goes back to what I was telling you about my sister, where if there's extra money in the checking account, it'll get used for sure very soon. And so she, for example, should not keep her emergency fund in her checking account. She might think about keeping it in a savings account at the same bank. But if she finds that it's too easy for her to be transferring money over to checking so she can spend it, she actually ended up putting her savings account at a different bank. So she could still get it if she really needed it, but so it took a little extra effort, and she was less likely to use it unless it really was an emergency. Why am I stressing cash emergency funds as opposed to relying on the credit lines on your credit cards? Right now, that is particularly important because your credit lines are not guaranteed. Your credit card limits can be changed at any time. Your home equity line of credit, if you have one, can be changed at any time. They are not guaranteed. We saw this back in the Great Recession in 2008, 2009, and we've seen it to a certain extent now during the pandemic, where banks get worried that people aren't going to be able to pay their debts, and they start reducing credit lines on credit cards and reducing lines of credit on home equity loans. So don't think that if you have if you're only charging a couple $1,000s a month on your credit card and your credit limit is actually, $5 or $6 or $8 or $10,000, you may think, well, I'm good. If I have an emergency, I've got all this credit line. Don't count on it right now, especially. In normal times, that's fairly reliable, but now you could find yourself caught in a bind there. Now, if you're thinking to yourself, well, I don't have an emergency fund, at least nothing much to speak of. Maybe you don't use credit cards, or now you're listening to me about not counting on those credit lines for your substitute for an emergency fund. Right now, I wouldn't normally say this, but right now, if you do have debts that you're paying and you've been paying more than the minimum payments, and I congratulate you for doing that, right now, you might consider making just the minimum payments for a few months so that you can use the difference to start building up that little bit of cash emergency fund, just in case. This is probably the only time in my career that you'll ever hear me say, don't pay more than the minimum. It might be a good idea to save that difference to build up savings. But while we're talking about savings, let's talk about the different kinds of savings that we have. Right now, we're talking about an emergency fund that you don't know when you're going to need it. It's when your engine blows in your car. It's when the furnace dies in your house. It's when the cat needs to go to the veterinarian. Anything that happens where there's no way you could have planned for that expense, and suddenly you need, $500, $1,000, whatever it is. That kind of money you want to keep where it's easy to get at. So as I said before, a savings account is pretty ideal. You might look at a short-term CD, certificate of deposit at a bank, maybe a 60-day or 90-day one, so that uh, you'll have money available on a pretty regular basis. Other accounts would be money market accounts at a bank or a money market fund with a mutual fund company. But the most typical place to keep it is going to be a savings account. But you have other kinds of savings too. Uh, for example, short-term goals. Maybe your goal is buying a new car in the next year or two, buying some new furniture in the house, you know, whatever it is, something that you might be planning to do within the next year or two, or maybe even 3 or 4 or 5 years. Those are still considered short-term goals. You could still use the savings account or any of those other items I mentioned as a place to keep that money. You could also think about savings bonds. Savings bonds are good for short-term goals that won't happen within the coming year, because they pay a better interest rate right now than savings accounts do. They're not no interest rates right now are great, but with a savings bond you cannot cash it in for a year after you buy it. So it's a way of kind of locking yourself in so that you won't spend the money ahead of time, but it is also a downside. That's why you wouldn't use a savings bond for your emergency fund. Then you have long-term goals. The big one we always think about is retirement. It might be purchasing a home. If you're somebody early in your adulthood, and you know that's a few years off, but it's a goal that you want to own a home. For these things, where we're looking perhaps 10 years down the road, here you could look at mutual funds or other kinds of investments, like a combination of stock and bond mutual funds and cash. These target date mutual funds are specifically designed for retirement savings. They let you pick the target fund based on the approximate year that you expect to retire. So like my niece, who's obviously quite a bit younger than me, her target date would probably be around 2050. And the mutual fund for her for 2050, it would have quite a bit of stock, some bonds, not a whole lot of cash, because she's still 30 years away from retirement. As she gets closer to retirement age, that target date retirement fund is going to start to adjust, reducing the amount of stocks that it owns inside of it, increasing the amount of bonds and cash, so that by the time she gets closer to retirement, it's become more conservative, meaning that it won't have as much fluctuation in the value there. And then she can use that mutual fund to draw from once she's in retirement to supplement her income then once she's no longer working. The trick to saving is to make it easy. For most of us, that means making it automatic, something that happens without us having to do anything. This is why participating in your employer's 401k or 403b or 457 plan is so valuable. You sign up, you have a certain amount of money you've agreed to have taken out of your paycheck. It happens without you doing anything. You never have the money, so you don't have an opportunity to spend it before it gets saved. So that's why those retirement savings accounts work so well. You can mimic that to build an emergency fund or to save for short-term goals by setting up a recurring transfer from your checking account to your savings account to happen every payday. Maybe it's $10, maybe it's $20, maybe it's $100. As I said at the beginning, I don't really care how much you're saving, just save something. It will add up. And using these recurring transfers that you can set up with your bank will make sure that you are moving money from where it's so easy to spend in your checking account and putting it in savings where it will help you begin to build that emergency fund. It also just keeps it separate from the money that you're using for your monthly expenses so that it doesn't get confused, it doesn't get lost in the mix. During the pandemic, as I said earlier, there have been some ways that have made it a little easier for some of us to save. Student loans are still in suspension right now, and not having to make those payments, if your income didn't drop along with that, you might have actually found that you have more money to save than usual. And as I mentioned earlier, a lot of us have reduced expenses. For my household, it's that transportation. But my insurance company also gave us a little break on our auto insurance since they recognize almost nobody's driving anywhere. Um, for part of the pandemic, gyms weren't even open. You might have not felt comfortable going back yet. Maybe that's an expense you're not incurring. Maybe your kids are at home with you instead of in childcare. And as I said, a lot of us are not going out nearly as much as we were, either by choice or because of the space limitations that our restaurants currently have. So look for those things that indicate that you should be able to be saving money right now and take advantage of them. Now, on the other hand, maybe you're fine now. Your income easily covers your expenses. You're not very worried. You may be thinking, well, I don't really need to cut expenses. We're doing fine. Because of the uncertainty right now, and to be honest, we have uncertainty all the time. It's always good to have a plan ready of how you would cut expenses if you needed to. This is useful instead of trying to decide in the moment when you absolutely have to cut expenses, how you're going to do it. It's easier for us to make decisions when we aren't under pressure, when we're not scared, when we're not traumatized by something that's going on. And having a plan already made means that if you do suddenly need to cut your expenses, you're able to react much more quickly. You're able to respond more wisely with your spending choices when the need happens. And even if you are doing fine right now, there's nothing wrong with reducing expenses nonetheless. So let's move on now and talk about how can we handle a drop in income? Now, obviously, what we'd like to say here is, oh, well, I replaced the income. I get a new job, my hours go back up, whatever. But that may not be in the mix for right now. So let's talk about just dealing with what you do have and how to sort of wring the most out of it. One of the tools that I would suggest, and I don't actually have a form for you on this, but this is something you can do easily on a piece of paper, on your computer in a spreadsheet, those same spending categories that we were talking about, looking at how much you are spending now in each of them, and then making a plan for how you could reduce those expenses if you needed to. My husband and I actually did this a few years ago. He worked for a company that had been doing layoffs for years, and he felt that his number was about to come up. And we sat down and figured out if he got laid off, what were the things we would do right away. There were things like we would change our contract. We're actually not under contract at this point. We would go to a lower level of service with our TV, phone, internet provider. We might look for, we might switch to prepaid cell phones that we could get for less than our current plan. We might stop some of the contributions that we make. We had a number of things that we would have implemented right away if he had lost his job. So that's the purpose of the before and after column. You start with looking at where you are now, what you're spending now, and figure out how you could adjust and how much you could reduce your expenses if you needed to, and have this plan ready to use when needed. The other benefit, I mentioned this earlier, that that if you have a plan, you will make not only wiser decisions, but you will start reducing expenses sooner. That's important because research has shown us that when people suffer a drop in income, it often takes 6 months for them to adjust to that. You can dig yourself into a pretty good hole in 6 months if it takes you that long to adjust your spending. And each month that you haven't yet made a full adjustment, it means that you're either adding debt or you're eating into your savings, one or the other. So adjusting quickly means it's going to be easier to recover later because you have less debt. One of the ways to deal with a reduction in income is to find other resources to fill in for some of that. That's exactly what unemployment insurance is. And right now, the expansions for unemployment insurance, right now, you are still able to get the extra $300 a week through the middle of March. Hopefully we'll know soon whether the new assistance package that Congress is looking at will extend that further. And I've given you a link here to more information about unemployment guidelines if you need to understand those. We also have a lot of existing government assistance programs that were in place, before the pandemic. If you suffer a drop in income, you might find that suddenly you're eligible for our Supplemental Nutrition Assistance Program. SNAP used to be called food stamps. LIHEAP is a program to help limited resource households pay their heating bills. Medicaid is the health insurance of last resort for people of low income. And then temporary assistance for needy families, referred to as TANF. These are all ongoing assistance programs to help folks who have either fallen on hard times suddenly or who may have been in difficult circumstances for quite a while. And I've got a link to the place where you'll be able to see where to go to apply for these, where to get more information about each of them. So I said earlier I was going to give you an example of why even a moderate emergency fund could be very valuable. A lot of us have heard the guidelines that what you're supposed to have for an emergency fund, you're supposed to have, this is what the rule supposedly says, you should have enough money that you could cover your expenses for 6 months. Well, that's kind of a daunting goal. That's a significant amount of money. Sometimes we feel like, well, I'm never going to get that much money on hand, so why should I even bother? Here's an example of why you should bother. Here's an example that shows someone who had managed to scrape together $3,000. Doesn't sound like, well, it either sounds like a lot or it doesn't. It may sound like a lot when you're just starting saving. It may not sound like much compared with that standard I just told you about. You should have 6 months of expense money saved up. But here's the difference it would make for someone who did have $3,000 in an emergency fund and someone who didn't, someone who had no savings. We're talking about a loss of income to the tune of $1,000 a month that went on for 6 months. That means that this person is suffering a loss of income, a total loss of income of $6,000, $1,000 a month for 6 months. Let's look at what happens to the person who had the $3,000 emergency fund and the person who didn't. So the emergency fund has $3,000 in it. And so we're going to use that. We're going to use that $3,000 of savings to get by during this 6 months when we've lost this income. But that only covers half, right? We still have another $3,000 of expenses we no longer have income to cover. So we're going to have to go into debt for that. Maybe that's charged on a credit card. Maybe it's borrowed from a relative. Whatever it is, that's how we're going to cover this loss of $6,000 of income. $3,000 from savings, $3,000 in debt. Let's say that this person put it on a credit card, 18% interest. They figured out that they can manage $100 a month to pay toward that credit card. They're going to have it paid off in 3 years and 5 months at that rate. They will have paid a total of $1,000, $1,015 in interest over that 3 years. That means that the total of their payments is $4,000 because they charge $3,000. They pay another $1,000 in interest. So total cost to them was $4,000, including the $3,000 of emergency fund that they used. Their cost for covering that 6 months of expenses that they lost $1,000 a month, the cost to them to cover that was just a hair over $7,000. Now, Let's look at the person with no emergency fund. If they had no emergency fund, it means that they had no savings that they could use. They would end up going into debt twice as much as in our first scenario, going into debt $6,000. Again, let's assume that was put on a credit card at 18% interest. They have the same ability to repay, so they're paying $100 a month. That's all they can manage. Even though the debt that they accumulated is only twice as much as in the first scenario, it's going to take them almost 4 times as long to pay this off. Why? Because the interest on that $6,000 is going to be so much more that so much of their monthly payment of $100 goes toward interest instead of toward principal. They are going to end up paying almost $9,500 in interest. 9,500 plus the 6,000 of the original debt means that the total they will pay the credit card is $15,465. Look at the difference this made. The total cost to the second person of covering that $6,000 of lost income ended up being over $15,000. For the person who had a decent but modest emergency fund, it saved them, look at that, their cost was $7,000. The difference is $8,000 here. That $3,000 emergency fund ended up saving them $8,000. I think that's pretty amazing. It means that any amount of savings is worth having. This is kind of an aside. It's not so much about managing your money, but it's a way that you can lose a substantial amount of money. And it's through scams and frauds. Scammers love uncertainty and they love fear. Right now, even though we've got vaccines starting to be released and some of us have sort of learned how to live with this, we still have uncertainty. We still have fear. When we are stressed, when we're worried, when we're exhausted, and I don't know any parent I've talked to who has kids doing schooling from home who isn't exhausted, all of those things together make us vulnerable. Vulnerable to being deceived by someone. Remind yourself that if it sounds too good to be true, it probably is too good to be true. So how do you protect yourself? Train yourself to try to verify claims that people make to you and try not to let yourself be pressured, even if you're caught off guard. Let me give you a couple of examples. Let's say that you get a phone call and they say they're from your bank or they're from the IRS, and they claim that they need your information because there's been some sort of apparently fraudulent activity on your checking account or on your credit card, and they need your information in order to get this straightened out. I don't know. I'll hang up. I will pull out my credit card or look up the phone number from my bank, and I will call them on a number I know goes to the bank and not depend on whoever this was calling me. With the IRS right now, with the economic impact payments, both the 2 payments from last year and the one that's likely to be coming now, there are a number of frauds and scams around that. People saying, oh, you're not going to get your payment unless you do X, and we'll help you do that. We just need your bank account information. All of those should send red flags up in your mind, but these are very common things right now. There'll be people who will say, we'll help you we'll help you get your vaccinations. We'll help you get that economic impact payment, but you got to pay us to do it. That is a form of fraud, telling you that you have to pay them to do something that you could do on your own. And of course, right now, because of the pandemic, they've been around before, and I'm sure they're still coming. You know, somebody touting the fact that they've got a secret cure. We know something the government doesn't want you to know about this. Anytime somebody's trying to tell you that what they have is a secret, what they have for you is information that not everybody can get, they're playing to your pride that you're special. but it's also a red flag that these are not legit. If it's something that you're seeing on social media, or if it's on a phone call, hang up. You don't need to hang on and try to figure out whether what they're saying is true or not. Just hang up. If it's something you're seeing on social media, stop reading. Even magazines can have what I consider to be scam articles in the back of them. There are ways with many of our social media to report ads that we think are fraudulent or misleading. And on Facebook, you can indicate you don't want to see any more ads like this. And so you can begin to reduce the amount of fraud that you might be coming across that way. Now, one fraud that unfortunately has been a pandemic in and of itself is the number of fraudulent applications for unemployment insurance that have happened not only in Illinois, but across the country. I personally know at least 3 individuals who found out that someone had filed for unemployment in their name, and they've had to go through the steps with the state of Illinois to get this straightened out. Here's the link for where you would report it. If you receive a debit card in the mail that says it came from the Illinois Department of Economic Security, if you get some sort of contact about unemployment and you have not filed for unemployment, go and fill out the form at this link here to let the state of Illinois know that someone is perpetrating fraud with unemployment insurance claims in your name. It can happen to you whether you are retired, whether you're currently working, or whether you are indeed unemployed. But maybe your benefits have been exhausted, or you didn't qualify for unemployment insurance initially. Let the state know that this is going on so that you don't end up getting a statement that you owe tax on this money that you never received. That would be like salt in the wound. How do we have a plan for managing our debt, especially in difficult times like this? Well, the first step is knowing how much you owe. And if you don't know how much you owe, that may be a symptom that you owe more than is comfortable, more than you should, and you need a plan to get it taken care of. The first step is creating a list of all your debts. This is another form from that Department of Labor workbook I mentioned earlier. It's very simple. You list all of your creditors, you list the interest rates of the debts, you list the balances, the required minimum monthly payment, if you're making a different payment, what that is, and maybe a note about the priority of this thing. What can they do to me if I don't pay this bill, for example. Once you've got a list of all of your debts, there's a very cool tool called PowerPay that was created by University of Utah Cooperative Extension, sister organization to University of Illinois Extension here where I worked before. You can do this online on your computer, or they have an app available for Apple phones, for iPhones. They don't yet have it for Android. But what it does is it takes your current budget with the debts you have right now that you're making payments on, and it will show you how to pay them down substantially faster. It's very simple, but usually you need somebody to show it to you and help you track that you're doing it. Now, this is an example that I did a while ago because you can see that I've got payoff times that are a few years in the past. But this person in my example here, I was saying they had 4 debts. One is a car loan. The other 3 were credit cards that I gave made up names to. The balances ranged from $1,000 up to $3,000, and the payments ranged from $25 up to $300. The interest rates varied widely. And if we continued making payments the way I've shown here, the first thing PowerPay does is it shows you how long it will take you to pay that individual debt off at that rate. And you can see that the Maxter credit card was going to take 5 months. The VIP credit card was going to take almost 6 years. The Crown First was not too bad, 2 years and 5 months. And then the car loan was going to be paid off relatively soon as well. What we know is that if you've been making these payments on time, you're able to live within this budget for paying off debt. So what PowerPay shows you to do is it will show you the impact of when you pay off the first debt taking that monthly payment and applying it to the next debt that you want to pay off most quickly. So in my example here, the MasterCard was going to be paid off in 5 months. So in month 6, PowerPay will show us take that $25, and instead of feeling like, oh, things are easy now, I can get takeout one extra time this week. Instead of that, they will show you the impact if you take the $25 and add it to the next debt that you want to pay off. You might decide to put it toward the VIP credit card because it's got that god-awful interest rate, 29%. Or you might say, the Crown First card isn't going to take me that long to pay off. I'm going to put it toward that one. Doesn't matter. Let's say you did put it toward Crown First. Now, instead of paying $25 a month to them, you're paying $50 a month. It's going to take you nowhere near 2 years to pay off that card. And as soon as it's paid off, you take that payment and add it to the next debt that you want to pay off. And when I ran this example on the PowerPay website, instead of the 5 years and 9 months that it was going to take this person to get debt-free by the time they paid off their VIP card, by using this PowerPay strategy, they were going to be debt-free in right about 2 years, less than half the time, with this very, very simple PowerPay strategy. Once you pay off one debt, structuring your budget so that you automatically take that money and apply it to the next debt, instead of, again, letting it sort of work its way through your fingers and losing track of where that money went. That was an example of someone who is able to make their payments. What if you can't? If you're not able to pay all of your bills, the first thing you want to do is prioritizing based on your family's safety and well-being, not based on which lender is calling and harassing you the most. Those calls can force you, the mental stress can force you to agree to make payments that either you can't afford or that aren't the best choice of where you should be putting your money. So one of the things you want to do is to weigh the impact of not paying for each of the debts that you have. Let's say that we've got someone who they have 2 debts. They have a car payment and they have a credit card payment. They can't pay both. They're only going to be able to pay one, and they're trying to decide which one to pay. Well, if you don't pay the car loan, what happens? Eventually, they're going to repossess the car. If that car is what it takes for you to be able to keep your job, that is a serious impact. On the other hand, we've got this credit card. What happens if I don't pay my credit card? Well, they might close the account. They're going to report late payments and non-payment to the credit reporting agencies. But they could even sue me. But that's all they can do. And those impacts of not paying probably pale in comparison with the risk of losing your job if your car were repossessed. So this is what I mean by weighing the impact of not paying. Can they take something from me? Like, can they kick me out of my house? Can they foreclose on my house? Yes. What if it's a hospital bill? It's not as if they can come and put your appendix back in because you didn't pay them. I'm not advocating not paying bills. I'm advocating if you can't pay everything, make sure that you're the ones who is deciding which bills are the most important to pay, not the lenders themselves pressuring you until you give in. When you decide, or if you are prioritizing and you know you're going to pay this bill, you're not going to pay this one, the one that you're not going to pay, call them right away. This is always important because when you tell a lender that you're not going to be able to pay, and especially if you tell them before you're late, they're going to be more willing to work with you. They may work out a new repayment plan. They might give you a break on interest rates for a while. They might give you a break for not paying for a couple of months or something, but it doesn't happen unless you ask. Right now, there's an added reason to let your lender know right away. if you are not behind yet when you call the lender, from the CARES Act that was passed last year, there's a protection that says if you negotiate with the lender and they provide some sort of accommodation, like I said, some of those things I listed, either foregoing the interest or reducing the interest rate for a while or letting you make interest-only payments, whatever it is, if you are current at the time they agreed to give you that accommodation, they have to report you to the credit reporting agencies as current, not late, but current. This is in effect from January of last year until whenever 120 days has passed since our national emergency was declared over. It has not been declared over yet. So we know we have at least another 4 months of this, even if they should say the national emergency is over next month, and I don't expect that to happen. This protects you for the future so that your credit history is not damaged, so that you'll be able to get a decent interest rate on a car, qualify more easily for a mortgage or a refi on your mortgage or whatever it is down the road. There are some things that we think about doing to take care of our problems with debt, some of which I think you need to think twice about rather than viewing them as a quick fix. One is a consolidation loan. A consolidation loan means that you actually take out a new loan and you use the proceeds to pay off other debts. For instance, you might take out a consolidation loan and you might use it to pay off a couple of credit cards, your car loan, maybe you bought some appliances or something on time from a local store. Used it to pay off all those things. You might see a lower interest rate than you did on your credit cards, but probably a much higher interest rate than was on your car loan. Probably, anyway. But the main thing about consolidation loans is they are typically structured to take a long time to pay off, even at the same interest rate as your debts that you paid off with the consolidation loan. Because you're paying so little compared to the principal each month, taking so long to pay it off, you're going to see a drastically increased total cost due to the added interest. And the other risk of this is, if you don't manage to reduce your spending and you continue spending at the same levels you were before, it's likely that in addition to having the consolidation loan, you may build up debt again on those credit cards. You may simply continue to spend in such a way that you continue to add to your debt and you end up in a worse place because of the consolidation loan rather than it having helped you. Some people also look to 401ks and IRAs. You can take loans against 401k, particularly during these times. You can take a hardship distribution from a 401k. From your IRA, mainly you would be looking at just taking a simple distribution. There are no hardship distributions from IRAs. But particularly with the 401k, if you took a loan, or if you took one of the qualified charitable distributions that were available last year that you were supposed to be able to pay back, if you lose your job, you're not going to be able to repay that loan or to replace the money that you took out from the qualified coronavirus distribution. So borrowing money or taking money out of retirement accounts, one, it's an expensive way to get money. You'll pay taxes and potentially a 10% penalty to get the money. And you're sacrificing the savings that you would have had for your retirement down the road, not just the amount that you take out, but all the growth it would have accumulated by the time you reached retirement. And another quick fix that you may see around is, I presume some of those credit card balance transfer offers are still coming out. 0% interest if you transfer your balance from your other cards to us. If you are carrying a balance and the zero interest rate will help you pay things down faster, there is a potential benefit there. But I have to caution you, because there is still the risk that if you don't manage your spending, that you will simply continue spending at the same level, especially now that you know you're not paying all that interest. You actually feel more comfortable, and you'll end up building up debt again on your other credit cards. So there are risks to using any of these quick fixes. And the last resort when you are having big trouble with debt is to file bankruptcy. It's a last resort because it's serious. It impacts your credit report for up to 10 years. You may have to give up things depending on which type of bankruptcy you file. We have two main types of bankruptcy for individuals. Chapter 7 is what we call straight bankruptcy, where you will have to give up many of your assets to pay the debts, but then any debts that cannot be paid that way will be forgiven. Chapter 13 operates differently. The court will determine how much they think you should be able to handle in payments to your debts each month. They will set up a repayment plan for you that will go over several years. Any debts that remain unpaid, if you successfully pay according to the plan the court gave you, the remaining debts will be forgiven. But bankruptcy is not a solution for everything. There are several kinds of debts that are not settled through bankruptcy, and this is the third bullet here I want you to pay attention to. Federal student loans typically cannot be settled through bankruptcy. Taxes that you owe, including tax liens, are not settled through bankruptcy, meaning they're not resolved. You still owe the money. Same thing with child support or alimony that you owe. Those will not be removed through bankruptcy. There's also another reason that you may not think about that would mean you shouldn't file bankruptcy, or rather that there's no need for you to file bankruptcy. And that is if you're in a situation known as being judgment proof. Judgment proof is kind of a slang phrase that means that nobody can really sue you and get anything. That's what it refers to. Who is in that situation? Somebody who has basically no assets, and their income is either so limited or it's from sources that are protected so that no court would be able to garnish your income in order to pay a lender. The types of income that are protected include Social Security, SSI, which is Supplemental Security Income, unemployment, any type of public assistance, veterans benefits, child support, and federal retirement benefits. All of those are protected income that cannot be seized or garnished through a court order by any lender except the federal government. If you do owe the federal government, these protections do not apply to them. So let's talk briefly about the CARES Act and some other forms of government assistance that that you have. Mortgage forbearance was a big item that was included in the CARES Act last year. It is still available, depending on which branch of the federal government your mortgage is from. You may have to request forbearance by February 28th. It's not a firm deadline for all sources of federal mortgages, but it is for some. How does forbearance work? It's only for loans that are owned or backed by the U.S. government. You'll have to show that you are suffering a financial impact because of COVID-19, higher expenses, lost a job, what have you. The forbearance means that you will not have to make your mortgage payments, and the initial forbearance could be for as long as 180 days. And if by the end of that 180 days or whatever amount of time you were approved for, if you're still having financial impacts from the coronavirus, you can request an extension for up to another 180 days. Similarly to what I talked about, if you negotiated accommodations from other lenders, if you receive a mortgage forbearance, you will be reported to the credit bureau as current on that mortgage. This is why getting forbearance rather than simply not making the payments is huge. Now, a couple of things that you want to ask about the forbearance before you agree to it is, how are these skipped payments made up? The rules are better now than they were at the beginning, but you should ask to make sure that they're not going to ask you for a lump sum of all these unpaid monthly payments at the end of the forbearance. Preferably, they're going to tack it on to the end of your mortgage, extending the length of your mortgage. But make sure you know before you agree when and how you'll have to make up for those skipped payments. Also, if you're not making your mortgage payments, how is your insurance and your property tax going to be paid if that's normally escrowed out of your monthly payments? So make sure that those things are going to be handled and that you're not going to end up with, an insurance policy that lapses, or with taxes so late that you have to go through hoops to keep your house. The CARES Act also instituted forbearance for student loans, for federal loans, and they were automatically, payments were automatically stopped March of last year, and the current end date for this is now September 30th of 2021. So federal student loans, if you have a loan that has been in forbearance, that at this point is expected to continue all the way through September. And again, these will be reported as current to the credit reporting agencies, so there are no dings on your credit reports because of this. This is what I mentioned earlier, that if you do negotiate with other lenders while we're still in this national emergency, that if you were current at the time you made that negotiation, they must report you as current to the credit reporting agencies as well. Another small thing, but important, if you have the mortgage forbearance or the student loan forbearance, or have negotiated with a lender who should be reporting you as current, you actually have a vehicle now to help you keep track of that. We always have free annual credit reports, but now through the end of April, the three major credit reporting agencies have agreed to give us free weekly credit reports so that you can make sure that if your accounts are supposed to be reported as current, you can verify on a weekly or monthly basis that that is actually happening. You cannot request these weekly reports by phone or by mailing in a form. You must do it online. And you will do it by going to the same place that you go for your annual credit reports that are free, by going to www.annualcreditreport.com. Just a couple of words about retirement plans during the time of the coronavirus. The CARES Act last year made it easier to get money out of your 401k and IRA. I alluded to some of this earlier. The CARES Act allowed you to borrow more from your 401k. The payments were delayed until this year. So if you did take a loan from your 401k last year that you were able to take because of the CARES Act, you probably had enjoyed not having to make those payments during 2020, but the payments are due now. That may be a rude surprise. If you aren't able to pay, you could end up not only paying tax on the amount that you received, but also that 10% penalty if you're under age 59 and a half. If you took out, instead of a loan, if you took out a coronavirus related distribution, that was the actual term for a special type of hardship distribution. The terms of the coronavirus related distribution said you could repay it within 3 years. In other words, it was kind of like a loan, kind of like a rollover. And if you did repay the money within 3 years, then there would be no penalty, no tax to you. If you don't pay it within 3 years, you will then owe tax, but they will not assess the 10% penalty on you. But coronavirus-related distributions were only available last year. So at this point, it's really the tax ramifications that you want to pay attention to. It's going to make your taxes for 2021 and 2022 and 2023 a little more complicated, but if you are able to make the repayment, you can spread, if you aren't able to make the repayment, you can spread the tax over the 3 years, 2021, 2022, 2023. We already talked about the SNAP and LIHEAP and those types of existing government assistance for low-income households. If you didn't already receive your economic impact payments that were sent out last year, but you are eligible, be sure you file your taxes for 2020. You'll be able to claim those economic impact payments that you did not receive but were eligible when you file your 2020 taxes. It's a special line, I think it's line 30, where you will report maybe you were eligible for a certain dollar amount, but you only received a lesser amount. This is your chance to get the remainder. We talked about unemployment insurance. As I said, for right now, we still have an enhanced unemployment benefit that will go through the middle of March. In the current Biden COVID relief plan, there are plans to continue that enhanced unemployment insurance, but we have to wait and see exactly how that bill turns out. So like I said, there are a variety of tools that are there to help you get through this time. If you're now, through the course of this evening, we've talked about a variety of worksheets, calculators, the tool from the University of Utah to help you with your payment calculations, to pay your bills back, to pay your debts back. You'll find links to all of those on my webpage. If you go to the resources tab, so KarenChanFinancialEd.com/resources, and look for the name of tonight's program, which is Money Skills for Tough Times. And you'll find all of these links there. They'll include links to tools that I created, like some of those worksheets. They'll include links to the Savings Fitness book from the Department of Labor. That's where a number of those worksheets were from that I mentioned were coming from Department of Labor. And then a number of worksheets from University of Illinois Extension, from materials that they have put together for their volunteers that serve as money mentors. And they've been gracious enough to post these worksheets and so forth online where they're available to the general public. So we've covered kind of a wide variety of things tonight under this heading of Money Skills for Tough Times. I'm sure some of it you probably listened to and said, I either do that or, well, that doesn't work in my situation, but I hope there was a piece that does work for you. And I know Ashley has been monitoring questions that you've been posting. So let's ask Ashley to open up her mic and tell us what kinds of questions we have to try to help you a little bit more tonight.
Sure thing. We do have a couple questions. It says, what would you recommend to couples where one person is the primary or designated financial person and the other person literally doesn't have any knowledge of the accounts, account information, balances? How do you recommend starting an initial conversation to get the second person involved in the couple's finances?
Okay, so it sounds like the way this question is phrased, that the person who's attending tonight is the financial person and they want the other spouse to be more involved. First thing I will say is, when you bring up this subject, if you expect it's going to be awkward or somehow threatening or uncomfortable, maybe it's something you haven't had good conversations about in the past, make sure that you're choosing a calm time when neither one of you is particularly stressed or upset. Maybe even saying, setting a time, saying, there's a couple of things that I want to talk to you about regarding maybe even saying regarding our finances. How about after our show we watch tonight on TV, can we talk for 15 minutes? I would suggest thinking about easy ways to let them become familiar without necessarily taking charge. It might be, okay, perhaps you still pay bills with checks. If so, an easy way is to say, I want you to sit down with me when I pay the bills next time. Help me write the checks, just giving you a sense of where the money goes. It is a joint household. I want you to be familiar with this. Even just providing written information. Now, I have to say, in my household, I'm the financial person, My husband is not very hands-on with any of this, but what he will respond to is, I give him printout every once in a while. He'll say, give me a report. It's kind of gotten to be a joke. Every few months or a few weeks, he might say, give me a report. And he won't look at it in detail the way I would, but nonetheless, he's getting an overall picture of where we stand, where our money goes, where our savings are, and that sort of thing. I don't know that there's any rule about how to do this, but I would say take baby steps, try to ease them into it, try to understand, maybe anticipate what it is that might be difficult for them about this. And maybe it's as simple as you're good at it, you're comfortable with it, and over time, you've just sort of taken it over and the other person hasn't needed to be aware. But right now, everybody needs to be aware. It's never healthy in a married situation for one person to have complete control. To be honest, it's not. So I think you're asking the right question. Your intent is good. Take it slow. Be considerate. I think you'll be able to figure it out.
Okay. And then I think you kind of mentioned this, but what about using credit cards and paying off balances in full each month versus using cash, given the attractive cashback rewards programs that many credit cards offer?
Okay. If you're someone who pays off your credit card every month, and so you're not incurring interest charges, there's actually nothing wrong with using your credit card as your go-to way of paying for any and everything and simply paying it off and, as you said, reaping the benefits. The only situation where that might not be ideal right now is, as I said, if you simply have no savings. But if you're someone who's not been paying interest on a credit card to start with, I really don't want you to stop paying it in full every month and bear those interest charges that you've never had before. That would seem to me to be a situation where you need to pare back on the spending so that you can build up the savings. But if you've got an emergency fund, you're a convenience credit card user, meaning that you pay it off every month, then the only advantage in that case that I could see to using cash to buy things rather than a credit card would be it's more concrete. There's research that shows if you do spend cash, you'll probably spend anywhere from 10 to 20% less simply because you're using cash instead of plastic. So there's kind of a built-in advantage right there. Although that research is getting a little older, so I'd like to see that repeated to be sure that that's still the case. But I can't argue with the convenience of using a credit card in that way. The rewards can be substantial, and for some people, it's a good management tool because they can see where all their money is going. Easy to download into Quicken or into a spreadsheet, or some credit cards, of course, offer you summaries at the end of the year so you can see where your money went. So not really a red flag in my book.
All right. And then I had a comment about the unemployment fraud. That has been is there anything that anybody can do to prevent that, or it's just kind of luck of the draw? How does that even happen?
So I have yet to read anything that clearly explains how you become a victim. So I think all we can say at this point is that it's more imperative than ever to follow safe practices regarding passwords and logins and so forth. And you've heard this all before, but long, difficult passwords, unique passwords on every account, particularly every financial account and every social media account, because those are ones that tend to be, that's what unlocks doors. And so you don't want any account, any password to be the same on, let's say, your Twitter account and your checking account. Those should those should all be totally unique. Yes, that's a pain. It probably means that you may choose to start using a password manager. Consumer Reports from time to time has had some good articles about password managers, helping you understand how they work, about the security that they use, and rating various ones. And of course, through the library, you'd be able to access Consumer Reports articles without having to pay for an online membership. So you could check that out.
Good plug, Karen. Thanks.
Well, I use it myself all the time. So it's one of those ways that my library saves me money. I don't know that freezing your credit reports is going to help with this particular fraud, but it can't hurt. And I do know from the individuals that I've talked to who have been a victim of this, that this is what the police officers told them to do, was to freeze their credit reports. If you have been told that you've been hacked, who hasn't, over the past 6 or 8 years with all of these various situations where, databases were broken into and so forth. At this point, you really kind of have to assume that there is information about you being sold on the black market. And if you have been a victim of one of those hacks, you should have changed your passwords on those accounts. If you were lazy and didn't, you should go ahead and do it now. But the main thing is unique, difficult passwords on virtually every login that you have. Now, there's one thing I'm going to relate a little personal story here. I had always been alarmed when I set up a new login. Let's say I went to a web page for Grandma's Pecan Pies, and I wanted to order some pies, and they said, well, I could set up my own username and password, or I could use my Google login, or I could use my Facebook login. And in my mind, I thought, why on earth do I want this little mom and pop business, Grandma's Pecan Pies, to know my Facebook login or my Google login? And so I always resisted doing that. I didn't understand how it works. And actually, it's not a bad idea for things like that to use your Google or your Facebook login, or whatever it is they're asking you to use, because actually Grandma's Pecan Pies doesn't know what your login is to that main account. They simply get a token. You'll be sent to go log in, if you aren't already, to Google or to Facebook, and Facebook will send a token to Grandma's Pecan Pie saying, we have verified this person, let them in. And if I decide I don't like Grandma's Pecan Pies, instead of having to go and try to figure out how to close my account with her, which may not be possible, all I have to do is tell Google or Facebook, you know what, sever that connection with Grandma's Pecan Pies. I don't want to use that anymore. And now my ability to get into that account is closed. And it can be a lot easier than I said, trying to go through and close accounts, especially with smaller vendors where they just don't have user-friendly services like that. So yeah, fraud is a problem. One other thing I'll mention. I do a program about fraud. I have a number of resources related to that on the resources page of my website that's listed here on this last slide. So if you go to resources and look for, the title is Recognizing and Preventing Financial Fraud. And I think that's how it's listed on that page. You'll find some additional resources there that may help you as far as, like, if you do want to freeze your credit reports, but you don't know how that works, or you want to study up on that a bit more, or any of these other things that have to do with protecting ourselves, protecting our identity. Yeah, it's a good topic. Good question. Not a fun one.
Very good. Well, Karen, as always, it's a pleasure having you and all of your solid information. And I think you gave everybody a lot to think about, and some resources and some tools to hopefully make a tough time a little easier. So thank you.
Always a pleasure. Thank you.
All right, everyone. And remember to look on the YouTube for this recording. Have a great night. Bye-bye.